Welcome back to the show here.
Thanks so much. And with my time with you today, I'd like to talk about what I would call resisting recency bias. So last time I was on, which was a couple months ago, we talked about herding, which is when people pile into one side of a trade or another. And again, there are times when that is really valuable to find because there's an investable opportunity there a lot of times. Recency bias is one of those things that if you've ever heard the quote, past performance does not guarantee future results, which is a disclaimer on most any investment thing you will ever read, that plays to recency bias, which is the fact that we tend to assume that whatever is happening or whatever has been happening recently will continue to happen. Now, that is different from trend following and momentum investing. And what I hope to do today is just explain what those differences are and what recency bias is, and hopefully get some clarity about how you can recognize it and combat it. The blog that I mentioned, I'm excited to start writing for stockcharts.com is called The Mindful Investor. And at my ChartCom presentation, I compared this paradigm of the mindless investor to the mindful investor. So I'd love to just spend a couple minutes explaining these two and then go from there. So many of us fall into the trap of mindless living, and when it comes to investing, mindless investing. So, mindfulness, in my opinion, is not just being aware of, being mindful of what's going on around you, but it's understanding your relationship to the different time frames. So, what has happened before this moment, what is happening at this moment, and what could be happening next. And I found that in life, just like we become fixated on the past through some, challenging life experience, or we get focused on the future and way too anxious about something that might happen or could happen. What happens is we ignore what's going on around us. And as investors, that presents plenty of challenges as well. So what a mindless investor does, which I think you will probably find snippets of this in your own investing, and hopefully we can work together over time to minimize that. But we tend to ignore the past. So we focus on what's going to happen next. We focused on the next home run, the next big idea, and something that didn't go well, we just kind of push that aside mentally. We worry about the present. So instead of looking around with opportunistic perspective, we worry about what's going on. The movements in the market, the volatility generate fear, which causes us to make bad decisions. And finally, we are fearful about the future. That anxiety about what could happen and all these potential future paths causes us anxiety. And as a result, you make bad decisions now based on something that may or may not happen. So, and one other comment on this, you'll notice that there's sort of a linear relationship to the time, right? So the past is what happened before us, the future is what's coming next, and there we are in the middle at the present, and we think of it in a linear relationship. What a mindful investor is hopefully able to do is have a much healthier relationship at one time with all of those different time periods. So any of you that have experimented with mindfulness meditation or any sort of mindful training, you'll know that it's a lot about the now. It's a lot about having a heightened sensation of what's happening around you. Because if we get too focused on the past or the future, we forget to stop and smell the roses, to look at what's happening, to use all of our senses. And as investors, that is what tends to happen as well. So what a mindful investor does is able to learn from the past. So instead of forgetting and ignoring what had happened, you learn from it. So things that might fit into that category would be things like a trading journal that Gaddis Rose and Grayson Rose talk very well about in some of their presentations. It's doing things like reviewing a bad trade that you've made or reviewing a good trade that you've made and trying to understand, get inside your mindset, what caused you to make that good decision or that poor decision, and how can you adjust your plan going forward. Also, you plan for the future. So instead of worrying about what could happen next or worry about what trade might go against you, you have a game plan. So you have a trading plan that is well articulated. You have a sense, you have lines in the sand that when a market moves against you or when a trade moves against you, you agree to revisit it. And so you don't have to worry about what might happen because you have a plan in place that's going to help you minimize the negative impact. And finally, maybe most important, you live in the now. You don't worry so much about the past and worry so much about the future. You're aware of what's happening now. And my research firm called Sierra Alpha Research comes from aviation, and Sierra Alpha is slang for situational awareness, which is essentially a pilot's term for recognizing your surroundings and being aware of it. So when you're flying an airplane, you need to be looking out the window, and you need to, or out the cockpit, and you need to be aware of other planes that might be on a collision course. You have to be aware of a mountain that's in front of you. You have to be aware of where you might land in case of emergency. But you also have to be aware of your instruments and understand the condition of the plane and fuel and all of that. And a lot of bad decision making as a pilot comes from not having an awareness and making a decision that's not based on having all the information in front of you. So what's good is those of you on the show today or watching have access to stockcharts.com, which has plenty of really effective tools to give you an awareness of what's happening around you. And that's everything from just having good charts to understand how an individual stock or group or sector is moving. It's also things like a relative rotation graph, screening tools to allow you to look at the entire universe of interest and focus in on what should be most important. So there's a poll that we have going right now that I'd love those of you on would take a few moments and think about. You probably do well with one or two of these. You probably do well with the present, with your current toolkit. Or you may have a good plan for the future, a good trading plan, or you might keep a trading journal, do well. But I bet there's one or two of those that you probably do not do well, that you could focus more of your attention on. And I'd be very interested to know, and maybe we'll visit the results at the end of our discussion. Which one of these are you struggling with? Which one of these do you find you do not pay as much attention to? And then over time, hopefully we'll help you address each one of these and ramp up your capabilities with it. So the one bias that, again, what causes bad relationships with these timeframes? A lot of times it's behavioral biases that are hardwired into our brain. There's certain things that we do as humans which come from human beings evolving over many years. And again, some of these things helped you when you were running away from a tiger or trying to find something to eat, but unfortunately does not map very well to good investment decision making. So there's a lot of things that we just need to be aware of and hopefully find some techniques to help minimize the impact of these on our decisions. So recency bias is a commonly followed technique, which essentially is our assumption that whatever has happened recently will continue to happen. And it's very timely right now in the US markets because so many stocks like an Amazon feel like they've been in an uptrend forever, right? They've continued to go higher highs, higher lows, upward sloping moving averages. Amazon has been a consistent outperformer. So the assumption, without knowing anything else, is of course this is just going to continue higher forever, right? Because that's what stocks should do. Now, as we know, those of you that have been trading for many years or many cycles will know that that's not the case. It is the case until it's not anymore, right? So things continue in one direction until the trend is over. It's the end of the trend. And understanding when that is happening, having some sense of what you would need to see for you to make a change in your position or your outlook, and then just having some sort of checks and balances to make sure that you're aware of when trends are changing. That's what really helps you minimize recency bias. Because on its own, it's okay. There is an inertia to trends, and stocks going up will tend to continue higher. Stocks going down will continue to go lower. But without a toolkit to help you identify when that's ending, is where you end up holding onto a position much longer than probably beneficial for you. Now, we make these assumptions not just with analyzing individual stocks, but we make these with many investment decisions. And there's a reason why anything you read that talks about performance of an investment vehicle will always have some sort of disclaimer of past performance does not guarantee future results, or something with similar language. Now, you see it a lot of times with mutual funds. So, probably one of the most painful things you can do is look at mutual funds that have done well over like a 5-year period and bet on them to do well over the next 5 years. Because if you look at the data, it actually tends not to work. In general, you're better off looking at the funds that have been underperforming over the last 5 years, because those are what tend to do well. And that's based on the natural cycle in the market, that certain investment themes will work, and then at some point they will not because of the changing conditions. So, we have the ability on stock charts to do some really good screens on on mutual funds, on ETFs, on stocks making new highs, making new lows in different conditions. But again, in general, looking at fund performance over that sort of time frame and then betting on it to continue just because that's what's happened so far doesn't tend to be an effective investment approach. So how do we try to combat this recency bias, this assumption that things will continue perpetually? Well, there's sort of two ways to think about it, and it gets to the different types of technical approaches. So if we think of the difference between leading indicators and lagging indicators, that's what's going to help us sort of come up with a good list to start with. So leading indicators, I would think of it as anticipating the trend. These are tools that are going to help you anticipate what's coming next. These are things that are going to try to get ahead of an inflection point. It's going to tell you something's happening before it happens. And I think of these as sort of red flag indicators. When one of these triggers, I put it on a watch list, I put it in a chart list, and then I make sure that I follow what's happened after. So some common things that might fit into this category, I would consider support and resistance levels as one of those. So if there's a certain high, right, a stock hits a high that where it has hit resistance before, we might anticipate that there will be resistance again. And that's the technical analysis 101 of using support and resistance levels. It's thinking that there are levels in a market that are meaningful. So with the chart of Starbucks that you see on the slide here, it pulled down to around 55 or so a number of times. That's a support level that we might anticipate it's going to continue to find support at. Finally, we gap down, and then we have to reevaluate. Okay, now that we're at new lows, how do we think of support and resistance? But in general, there's value in looking at where a stock has turned previously. Second leading indicator I think of would be oscillators, and RSI is a common one that I use regularly, which is just trying to measure the momentum behind a stock move. So when a stock or a sector or an ETF becomes overbought or oversold, that on its own does not tell you that the trend is over. It just tells you that it's gone in one direction a long time and longer than it tends to for that specific instrument. So it's not telling you that the market is absolutely going to reverse, but it should put it on a watch list, on a red flag list, just to be aware of a potential reversal. You want to see the reversal in the price itself. So that gets us to the lagging indicator side. These are things that are not meant to anticipate the trend, but more to follow the trend. And there are most of the technical toolkit, especially on the institutional side where I've spent a lot of my career, is in trend following. So you're not trying to pick the top or the bottom. You're trying to follow the trends after they've emerged, because there's a lot of money to be made on the trends as they play out, and as people buy into an investment idea over time and cause the persistence of trends. So common things that might fit into that category, one would be Dow Theory, which is just the idea that an uptrend is higher highs and higher lows, a downtrend is lower lows and lower highs. So just by looking at the peaks and the valleys in the price of an instrument, you can make a very simplistic assumption of what the trend is. And when I teach technical analysis, the very first thing that I've always had my students do is answer the question, is this stock in an uptrend or a downtrend? Because until you've clarified that, there is nothing else that you really want to talk about, because that is the simplistic, basic building block of price movements. So in this chart of Starbucks, we can see a clear uptrend from the low in July after it started to rally. We see a consistent pattern of higher highs, a pattern of higher lows, and that is what defines an uptrend. That is what defines the fact that the stock at this point has been going higher. Finally, it's moving averages, or something, a derivative of moving averages. So MACD is probably a commonly used one. So any sort of moving average by definition is lagging behind the price. It's smoothing out the price movements, not necessarily jumping the gun and trying to tell the future of what's happening, but it's more to recognize and respect when the trend has reversed. And there are many trading systems and simplistic ways you can look at markets using a simple moving average crossover system, which again is not going to pick the ultimate high and low, but is going to help you be into the meat of a trend. And we'll look at some examples of each of these as we go through them. So some of the leading indicators we've talked about, let's look at each of these. And the first is looking at support and resistance. My first suggestion to you is, when you're looking at a price chart, start at the current price and then look to the left. So right now, this is a chart of Facebook from earlier this morning. At the time I took the screenshot, trading around 160. The first thing we want to do is look left on the chart to see where are we at relative to consistent support and resistance levels. Where are we at relative to levels where I think there might be a meaningful reversal? Now, in the blue dashed lines here, I've highlighted just visually where have I seen support and resistance. So 170 has been a consistent support level for Facebook. If you look back a number of times, when it's been above, it's come down, and that's served as support. And so again, if and when we come down to that level, I'm certainly going to recognize the fact that just because that has been support so many times, I want to be aware of it and potentially make a bet as a result of that. Since we've now broken below that, we're in a confirmed downtrend with Facebook of lower lows and lower highs. I have to look to the left, and I'm seeing maybe a short-term support around 156, which was the swing low before the gap higher in April. I'm also looking at the historical lows around 150, 151, which is where was really the low in Facebook after the peak at the end of January. So as we go lower, I'm keying in on those levels as potential levels where I might anticipate some buying power to come in. And again, that's not saying it's going to happen, but it's a level that I want to pay attention to. And maybe I set an alert for when Facebook gets near to some of those key levels. If we would rally, that's when I start to look left and pay attention to historical resistance levels. So in this case, 195, which was resistance. This was the previous all-time high before it broke higher, and then the ultimate high before the huge gap down in July. So again, you start with where you're at now, and you look left on the chart and find the most meaningful levels to pay attention to. So again, what that's doing is it's ignoring the current trend, and it's just paying attention to price levels. What levels do you want to set on an alert, set on a spreadsheet, write on a notepad, that when the price hits that level, you promise to revisit your position or revisit your outlook. The second sort of leading indicator approach we can use is what I call watch for extremes. And this is looking at oscillators, looking at momentum indicators. And one of the common ones that I've used for years is RSI. Simplistic technique. It's a simple way of measuring price momentum, but I think the beauty is in the simplicity and the fact that it's consistent. So you can look across an entire list of stocks or a sector and sort them based on the RSI, and you will very quickly identify what's been working and what has not over a certain time frame. Healthcare is an interesting example to use right now because it has recently become what I would call extremely overbought, or an RSI above 80. So let's dig into that just a little bit at the bottom here and talk about it. So when the RSI in general tends to fluctuate, or by definition from 0 to 100, we tend to consider 30 to be oversold. So when the RSI gets below there, you'd anticipate a short rally. And when the RSI gets above 70, that's overbought, and we'd expect a short-term downside correction. But if you look at when the RSI became extremely overbought or above 80, that tends to be, especially early on in the trend, tends to suggest a short-term correction, but a persistence or a continuation of that existing trend. And I guess the way I've thought of it behaviorally is there's so much momentum behind the stock or the ETF, you'd expect that momentum may continue even further. That did not happen here at the beginning of 2018. That was sort of the blow-off rally. So when you see this happen at the end of a move, after an extended trend, you almost think the opposite. That might be one last gasp to the upside. Here, however, the XLV has been more earlier on in the trend, just recently breaking to new highs, a resumption of the uptrend, upward sloping moving averages. We see that the RSI became extremely overbought. So it suggests further upside overall over the long term. What's concerning here to me is similar, Tom, to one of the stocks you showed earlier, which is this bearish divergence of higher highs, might have been airlines if I remember right, and this downside divergence with RSI. So suggesting the momentum is lightening up on each of those uptrends. So again, depending on your approach, this may not be like a trading system. You might not say, all right, when the RSI hits 70, I'm going to sell. And I certainly wouldn't recommend doing something like that in a vacuum. But noting that something is overbought or oversold, or noting a divergence, is what puts something like XLV on my radar, on a correction watch. Just understanding this has become extended, it's gone up a lot, or it's gone in one direction, and I want to be aware, I want to get ahead of any sort of turn. And I'm looking for the price to make some sort of distributive movement, make some sort of turn that might confirm what I'm seeing in the oscillator. But at this point, it's still going up, and I have to respect the price, that the fact that the price is going higher. So to finish up, we'll talk about the lagging side of it. So we've talked about leading indicators like support and resistance and RSI. Let's talk about lagging indicators and a couple that come to mind. One is Dow Theory, which is, as I mentioned, it's the very first thing I always teach younger analysts or people just getting started with technical analysis, because you have to start with price. Is the price going up or is the price going down? And that should be the basic starting point to your analysis. So this is a chart of the S&P 500, and again, is the price in an uptrend or a downtrend? Well, by Charles Dow's definition, it's in a clear uptrend of higher highs and higher lows. And what I'm looking for on any sort of volatility, any sort of pullback, are we putting in a higher low? And what has continued to happen with the S&P, with the Dow, is that we've continued to put in a higher low. Where we've not seen this higher low is in global markets, in something like EM or frontier markets, where we've actually seen the opposite. We've seen lower lows and lower highs. So Dow Theory on its own can be a good lagging indicator confirming that something has reversed. So recency bias tells us that this trend should go on forever. By watching for the highs and the lows relative to the previous swing highs and lows, we can confirm when that is no longer the case and make sure we take action as a result. Then the final thing I would say is just having something in your toolkit, some sort of trailing stop or some sort of level, some sort of indicator that's going to lag behind the price. And whether or not it is a trading signal for you, it should be something that causes you to revisit it. So, I've thrown a couple things on a long-term chart of the S&P. There's the 50 and 200-day moving averages, which again are, pretty simplistic model, but just looking at any time that this hits the 50-day moving average, I'm going to revisit and just say, how does this look? Are we still making a higher high, higher low? Am I still comfortable with it? That might be one way to think of it. I also put the Ichimoku cloud, which is a Japanese traditional technique. It's an interesting indicator and sort of beyond the scope of our discussion, but it's interesting because it projects into the future about 26 periods. So in this case, it's projecting 26 days forward. But I'm basically using the price movements now to project a level of support in an uptrend and a level of resistance in a downtrend. And as the cloud looks like this, it's telling us as the price is higher, sloping higher, this is an uptrend. If and when that changes and we start to break into the cloud, or when the cloud changes and reverses, that tells you need to revisit things. These are, at the very least, some line in the sand that's going to cause you to revisit it, and something that lags behind the price, I find is a really effective confirmation tool to prevent you from staying in a trade way too long. So just to very briefly wrap up here with 3 suggestions for you. Number 1, mix the systematic with the subjective. And so for me, my toolkit has a little of both. I like this the systematic nature of a basic trend following model. So in this case, I'm looking at the 50 or the 10 and 40 week moving averages on the S&P 500. As long as these are, the 10 week is above the 40 week, by definition of moving averages, it's going higher. So if and when that changes, I'm going to revisit my thesis that the market is going higher. And then you want to mix in the subjective. I would not consider this to be a standalone trading system, but it is something that's going to cause me to go into the sectors and the stocks that make up this index and make some decisions as a result of it. The second thing is always look for what is different, and this will help you fight recency bias. So if the market has been going up, which in the US there's no denying it has been, I always like, instead of looking at the new highs list, I like to look at the new lows list. What are the stocks in an uptrend that are no longer going up? And so in this case, I'm looking for NYSE stocks making essentially a new 52-week low. And again, not that I would automatically sell these or be negative on them, but I like to see what is not agreeing with the overall trend in the market. And that's, again, a starting point to see what's acting differently. And it'll help open up your mind to the fact that not everything is going up in a bull market and not everything is going down in a bear market. The final thing I would say is change the visualization. So, a consistent technical approach is very important. However, if we get too wedded to one way of looking at things, I find it's like putting blinders on. You eliminate the possibility of opening up. And that's why going to conferences like ChartCon are so helpful, because it helps to break you out of your routine. In this case, I've inverted the chart of Apple, and I actually learned this. I don't know if many of you know, but if you just put the minus sign before a ticker, it allows you to invert the chart. Very easy to do, and it just kind of reorients you to a new way of looking at it. So, Apple overall has been in a great uptrend. If I flip the chart over, is this the type of chart I might want to buy if this was a stock? And if so, boy, that might make me want to revisit the fact that Apple is a good long here. For many of you, you probably have not done that. Flip a chart over just to break yourself of the biases of knowing the chart of Apple so well, or whatever stock you trade. So those are three quick ways you can try and combat the impacts of recency bias. As I mentioned in the introduction, I'm really excited to start writing a full blog for stockcharts.com called The Mindful Investor. These are the types of themes we'll hopefully pick up on, looking at behavioral biases that impact your decisions. And what I like to do is focus on practical tools that are going to help you minimize the impacts of those biases on your decisions, and hopefully help you revisit your own investing and relationship with past, present, and future. So with that, I really appreciate it, Tom and Aaron. Pleasure to be with you as always, and I hope this was helpful.
Hey, Dave, I got a question.
Yeah.
So if I am in a losing trade and I flip the chart, does that mean that I'm now in a winning trade?
This could be an optimistic, fun thing to do when your positions are really going against you, Tom. I think that's probably true. It's funny, though, this is something I've done with institutional investors for years, which is take some of your best ideas and flip them over. And it's so funny how often you recognize that you just were, you thought of the chart of Apple and you're thinking of the products and not what the chart is telling you very plainly. And just by tweaking it a little bit, you find that you break out of that and realize, yeah, it might not be the best idea here.
Absolutely. Well, I think we had a question in the room. So Aaron, you want to start with that?
Indeed. Does your system work with all markets?
So, in general, I like to look at technical analysis as representing the underlying behavior of investors. So the tools that I use are all tools that I found over my career are good representations of fear and greed, and they're manifestations of that. So having said that, any market that is driven by those emotions and by emotional buy and selling of investors, I think it's absolutely worthy of. And I would say now it tends to be the most effective, arguably, on things like emerging markets, frontier markets, lesser known things, because that's where there is less transparency. There's more opportunities for emotional decisions to create volatility and create opportunities. Having said that, the only thing that I find these techniques are less effective on are things that are not driven by emotional buying and selling. So something like economic data, or something that may not, it's representing some sort of supply and demand that might not make sense with an emotional decision. That's where I've tended to stay away. But what I've described using ETFs, that's most things in the market that you could apply these sort of tools to.
Okay. Why don't we pull up that poll, because I think that was pretty interesting. You had a couple questions in there, and I think it fits right in with your discussion today. So if we can get that poll up and take a look at some of the percentages here for each. Maybe, do you have some comments looking at that, Dave?
Very interesting. I was wondering what the results would be, and two things that strike me. Number one, look how much some of us have struggled with each one of these, and that's exactly what I found. I have found, working with investors over my career, that people tend to do one or two of those very well, and they tend to do one or two of those, relatively speaking, a little less well. And I think that having an awareness of your own weaknesses and your own opportunities for growth, I think is fantastic as a trader or as an investor, because that's the upside for your own practice. It's funny also that most of us, the majority or the plurality, is with living for the present, which is something that mindfulness training was really designed for people to do more of, because it's very easy to get caught up with a bad trade, especially when you have a bad streak as a trader, as both of you probably can attest to. Boy, it's really hard to dig out of that mentally and just focus on what you're seeing now. And the same thing, it's way too often that we make a decision without a good plan for the future. So I think living for the present and having a good sense of what's happening around us. The good news is charts are probably the best tool I've found to give you that awareness. And yeah, this is great material for me to think about as I start to write the blog Mindful Investor, and think about how I can help each of us kind of focus on each of these. So thanks so much, everyone, for responding.
Yeah, that was an excellent presentation, and I agree. I mean, the fact that these three are so close together, it's like everyone is kind of struggling with a little bit different, little different demons, whether it's the past demons, the future demons, or trying to live, for the present. But great discussion. I knew everybody would enjoy this because it was such a great presentation at ChartCon. And it's always a pleasure to have you on here, Dave. Look forward to having you back soon.
Cheers, guys. Thanks so much. Have a great day, all right?
Absolutely. You too.
You do the same.